Ani, and welcome to this year's virtual annual general meeting of the Wikwemikong Trust. We hope that for those community members watching, the information provided today is informative and educational. The agenda for this year's annual general meeting will include opening remarks from the Wikwemikong Trust, a presentation by BDO on the 2019 Wikwemikong Trust audit, a presentation by our investment advisor, Peace Hills Trust, and a presentation by our two investment managers, Dixon Mitchell and Lincluden. At the end of this presentation, we will host our door prize draw and provide instructions on how to submit your answers. Prizes include a Google Nest Mini, an Amazon Fire TV stick, and an Apple iPad. Thank you again for taking part in our virtual annual general meeting. I would like to start off by introducing our current trustees: Janine Pitwanakwit, Marilyn Jocko, Robin Mantwabi, Andrew Mantwabi, and myself, Jocelyn Babankwe. Please note that our virtual annual general meeting is pre-recorded. Community members will not have a chance to have their questions answered through the presentation. We ask that you make notes and submit your questions to trust@mtelecom.net. All questions submitted will be posted to our website at www.wikwemikongtrust.com. The Wikwemikong Trust is set up as a financial vehicle. It is set up so the trust property is preserved and invested, with an annual payment of income transferred to Wikwemikong. The capital is invested to generate investment income, from which the annual payment is derived. Trustees' main role, with respect to how the trust property is used or spent, is through the investment of the trust property. Decisions on the use of the annual payment are made by Wikwemikong. The next 4 slides highlight the activities of the trust for 2019. In the first quarter, our 2019 operational budget was finalized. We posted for a new Trust Administrative Support Officer and had our quarterly meeting, which included an investment and audit review. In our second quarter, the net income available for distribution in the amount of $722,787 was transferred to Wikwemikong, after which Wikwemikong repaid the CPI in the amount of $334,229. In May, we hosted our yearly annual general meeting. We were able to fill the position of Trust Administrative Support Officer. And in June, we participated in the Community Open House. In our third quarter, we didn't have too much activity, but we did have our regular quarterly meeting. And in September, we posted for 2 new trustees. In our fourth quarter, the trustees attended the RIC Aboriginal Investment Workshop and started their online trust investment training. In November, Wikwemikong unceded territory was notified of a change in the investment policy statement, and in December, 2 trustees were appointed. That is the end of opening remarks. Now, on to door prize questions. Question number 1. As of December 31st, 2019, what is the amount of the trust capital for the Wikwemikong Trust? Question 2. Name any 2 of the Trust's current investment team. Question 3. Based on the Trust's 2019 financials, what was the total distribution amount to be transferred to Wikwemikong unceded territory? For a chance to win either an Apple iPad, a Google Nest Mini, or an Amazon Fire Stick TV, community members must answer all 3 questions correctly. Answers can be found in the Wikwemikong Trust Annual General Meeting presentation. Submit your answers to trust@mtelecom.net. Include your name and phone number along with your correct answers. Submissions will be accepted up to November 27th, 2020 at 4 p.m. The Wikwemikong Trust will contact winners by phone or email to make arrangements for prize delivery. Good luck!
Good afternoon, everyone. My name is Jennifer Archambault, and I'm a partner with BDO Canada. We performed the audit of the Wikwemikong Trust for the December 31st, 2019 year end. And today what I'm going to do is just take you through at a high level the financial statements and some information about the trust. So the first thing when the auditor is engaged to perform an audit, we look through all the information that is prepared and given to us by the organization, the trust. We do some testing, we go through all the system descriptions and everything like that. And once we're done doing all of our testing and looking at everything, we come up with our audit opinion. And that's what everybody's looking for when an audit is completed on an organization. So when you look at the trust's audit opinion, you can see here, this is what everybody looks to here, this opinion paragraph. And this is where us as auditors give our opinion on the financial statements. So in the trust's case, here is our opinion, that the accompanying financial statements present fairly in all material respects the financial position of the trust at December 31st, 2019, and the results of its operations, changes in the trust capital and cash flows for the year then ended. So this is what you call a clean opinion, and that's what you want to see. So that is all good. The audit opinion and the audit report now is very long compared to what it used to be. So after the opinion paragraph, it does go on to talk about the responsibilities of management and those charged with governance, the auditor's responsibility. And it goes on to a second page now and goes down to the end, and then you can see our signature, which notes that we have prepared the audit opinion. Okay, so that's the first thing that you would see when you went through the trust's financial statements. The first statement that I actually want to talk about is the statement of operations. So this statement goes through all of the transactions that happened in the trust for the whole year, starting January 1, 2019 till December 31st, 2019. And this statement always starts at the top here with your revenue. And you can see here that the total revenue that was generated for the trust was $1,106,000, and it's broken down into these three areas. The first being investment income of $612,000. So this investment income would be interest and dividends that were earned on the investment portfolios that the trust has with the various investment advisors and groups. Down a little bit from the previous year, but when we move to the next line here, the gain on sale of investments, this is actual sale of investments from the portfolio, and there was gains earned of $342,000, which again, much higher than the previous year, all depending on how the investment manager deals with the investments during the year. And the last item is the foreign exchange gains that were incurred of $152,000. And this again, US Canadian transactions happening within the investment portfolios creates gains and or sometimes losses when they're being translated from US dollars to Canadian dollars. So like I said, total revenue for the trust for the 19 year end, $1,106,000, up a little bit from the 2018 year. The next thing you look at is the expenses. And you can see the expenses for the organization. The total of the expenses were $263,000, which was down a little bit from the 2018 year end. And you can see as we go through the expenses, there's various expense lines. The accounting and auditing expenses of $13,000, fairly consistent with the previous year. Some amortization on the leaseholds that the trust has. There was bookkeeping fees of $5,600, and you can see this is where one of the larger changes happened from the previous year, and that's because in the previous year the trust contracted the First Nation to perform some administration and bookkeeping on their behalf. During the 19 year end, an employee was actually hired, which reduced these costs in the 2019 year end. There were some consulting costs of $5,200, insurance costs of $4,000, some investment management fees. This is the largest fee that the trust incurs of $133,000. These are fees that are paid to the various investment advisors. Legal fees of $1,700, and those again have decreased over the previous year, because in the previous year there was some specific legal work that was done in regards to the trust agreement, and those fees didn't get incurred in 2019. There's office in general of $24,000, down from last year. That this is going to be on a as needed basis, and just as many, not as many as expenses were needed in this year versus the previous year. Travel and conferences were down due to less travel to $16,000. The trustee honorariums were up to $24,425, and the wages and benefits were up as well to $31,000. And the wages and benefits were up as well because, like I mentioned earlier, an employee was hired to take on the trustee administration area, and that is what caused the increase. So if you take the total revenue of the organization of $1.1 million, less the expenses of the organization of $263,000, you end up with this excess of revenues over expenses of $843,000. Now, according to the trust agreement, the trust is actually required to pay this net annual income available for distribution out to the beneficiary, which is the unceded territory. And you can see, well, what is the net annual income available for distribution? Well, it's this $843,000. So that $843,161 is what needs to be paid out to the beneficiary of the trust, the unceded territory. And then that leaves an excess of revenue over expenses of zero, because everything that was generated got paid out, okay? And that's your statement of operations. If we flip to the next statement in the financial statement package, it's the statement of financial position. And this is a little bit different than the statement of operations that we just went through. This statement actually is at a point in time, and these balances that you see here are as at December 31st, 2019. So it's like someone took a picture at that point in time, and these were the balances at that time, okay? So this statement always goes through the current assets of an organization first. And you can see that there was regular cash in the bank of $226,000. There were short-term investments of $344,921, and some small prepaid expenses of $3,000. So in total, the trust had $574,000 of short-term or current assets. The largest asset that the trust has is its investment portfolio. And here it is here, this long-term investments of $19,188,000. What you can see here that there's short-term and long-term investments. What distinguishes one from the other is that a short-term investment is going to mature within 1 year of the year-end date of December 31st, and everything else that is not going to mature within 1 year, will be lumped into this long-term investments. Okay. So these investments here that are listed are on the statement of financial position at their fair market value at December 31st, 2019. So these are, if you sold all the portfolios at December 31st, this is what you would have received for those investments. It's not what the trust paid for them, that would be its cost. So for accounting purposes, remember that these investments are on the statement of financial position at their fair market value. And there's some small capital which were some leasehold improvements done on the golf course office where the trust operates out of. So the total assets that the trust had was $19,772,000. Oops, sorry. So if that was the assets that the trust had, down below you can see the liabilities that the trust needs to pay out. And there's not a lot of liabilities. The first liability of $11,000 are just regular accounts payable and accrued liabilities for services or goods that have been received prior to December 31st, 2019, but haven't been paid for because of it's a timing issue. They got paid in January 2020. Okay? And then the largest liability is this payable to the unceded territory or the beneficiary of the trust. And we just went through this number and how it was generated in the statement of operations. So this trust owes the unceded territory $843,161 of its income that was generated. So the last thing that's on this statement of financial position is the trust capital. And what it represents that is if at December 31st, 2019, all this $19,772,358 was turned into cash because you sold all your investments and you have all this big amount of cash. You paid off all of the liabilities of the trust of $854,985. You would end up with trust capital or leftover cash of $18,917,000. And that would be used to further the mandate of the trust. Okay. So the last thing then I want to speak about is the capital injection. So we just went through the statement of operations, the statement of financial position, and really what came out of there is that there was about $843,000 that had to be paid from the trust to the beneficiary of the trust, okay? And the next thing that's part of the trust agreement is that once the unceded territory gets that check from the trust for the distributions for 19, it needs to turn around and inject back into the trust an amount of capital based on a formula. And this slide here goes through how that capital injection was determined for the 2019 year end. Because for the 2019 year end, the capital injection that was needed to be made back into the trust was $429,732. So what is the formula to determine that $429,000? Well, it's based on the market value of the investments. So if you look right off our statement of financial position that we just went through, there was $344,921 of short-term investments, and there was $19,188,356 of long-term investments. When you add those two figures up, the total market value of investments is $19,533,277. And to determine the capital injection, you use the inflation rate as determined by Statistics Canada at December 31st, 2019, which was 2.2%. So if you times the 19 million times 2.2%, you get 429,732. Okay. So once the unceded territory gets that $800,000 check, they turn around and inject back into the trust the $429,000. And that's pretty much at a high level the transactions and things that occurred in the December 31st, 2019 year end. So hopefully I've answered all the questions that you might have. If there is some additional questions, please feel free to contact Leona and she can get a hold of me, and I would be glad to answer any other questions that you may have. Thank you very much.
Okay, good morning or good afternoon, everybody. This is Jeff Rakitich. I work with Peace Hills Trust, and I'm the consultant to the trust. And we are going to put together a short presentation. I'm going to be speaking on the goals of the trust and the investment policy statement. Then your two investment managers, Wayne Wilson from Lincluden and Don Stewart from Dixon Mitchell, will give short presentations briefly on their 2019 performance, but then certainly more information on what's been happening recently with COVID and 2020 being such a hectic time for everybody. So with that, we'll just plunge in. And since there will be members to ask questions, I will ask questions as we go if I think we need clarification on stuff. But both Wayne and Don have done many presentations. They've been doing this for years, and they're very good at this sort of thing. So here it is, report to membership. That's me. That's my qualifications. I'm the Assistant Vice President of Trust and Compliance Performance. I'm a Chartered Financial Analyst, CFA. I'm also a Chartered Professional Accountant and have a Commerce degree from the UBC. I've had about 30 years experience in the business. I've worked with First Nations of Yukon Territory and had my own firm in Toronto as a portfolio manager like these gentlemen. I've sat on investment committees, so lots of experience, and I've also been a trust officer. So, ongoing. Let's see if I can get that up to a full screen here. There we go. Ongoing performance monitor. So this is what we do. Peace Hills Trust, I act as your consultant to the Wiki trustees. So we do a lot of the administration work for the trustees, including we look at daily cash balances. When your investment managers make trades, we make sure that they're on side with cash positions. I look at monthly investment performance from each of these firms. Then we look at quarterly performance and compliance with the investment policy statement and with the trust. We pass that information along to trustees and report to them on a regular basis. I also do one-off reports for the trustees and sometimes for trustees and council as required. And one of our functions is to meet with membership, and we're doing it via Zoom call right now and through a recording, at least once a year to discuss the trust results. So that's our job, and that's what we do. So this is what we're looking for. The investment objectives of the trust, we're looking for sustainable wealth. So we want this money to be around for a long time and hopefully grow over time, excuse me, along with the income. So there's 4 different objectives of the trust. So the first is to seek modest capital appreciation after fees and inflation, maximize the tax-efficient generation of income in the form of interest, dividends, and capital gains to support the annual payment and other obligations of the trust. Basically, that means we're trying to grow this thing on a reasonable basis. We have about almost $20 million in the trust today, at the end of 2019. If we have $20 million in 30 years from now, we failed because we haven't covered inflation. Inflation is what eats away at the value of the money. So we have to cover inflation for sure. That's number 1. That's the first objective. The second one, maintain the safety of capital and minimize the downside risk through portfolio investment manager diversification. Safety of capital. We don't want to lose the money, okay? And we don't want this thing to go down in value very much as markets fluctuate up and down. We're going to talk about that in a second. Number 3, we need liquidity to meet the annual payment. There's no sense having all our money tied up in investments that we can't turn into cash because every year we have to make annual payments to the nation. So we have to have that cash available. Our fourth objective is to achieve an annual rate of return of 4%, in addition to recognizing performance that meets or exceeds expectations outlined within the review policy and the investment policy statement. So a real rate of return is after inflation. So if inflation is 2%, we want to make a real rate of return. So 2 plus 4 is 6. So we need a 6% return if inflation is 2. And that's what the government target is, and that's where it's been for quite some time. So did we meet that? Yes, we did. Okay, in 2019, the trust had about a combined return of over 14% and had a value at the end of the year of $19.7 million. So we achieved all those objectives through 2019. So how do we do this? okay? Putting the money into investments that are going to give us low returns like GICs and very little growth, that's not the way to do it, because we can't beat inflation with GICs and even now with straight bonds, because they're not giving us much of a return. So we have to invest the funds in a diversified portfolio that's going to give us a reasonable rate of return and grow the capital and produce more income over the future. If we have 20 million now, say, we can produce so much income. If we've got 25 million, we get to produce more income. So that's the objective here, is to grow that capital and in turn grow that income over time. And the way that the Wikwemikong Trust is being run, a lot of First Nations around the country are doing exactly the same as you guys are. They have different investment policy statements, but the principles are the same, and it's working across the country as it's working with Wikwemikong. So before we go on, I just want to talk very briefly about risk and return. In all the financial markets, we get paid a return for taking a risk, and every investment contains risk. There's no risk-free assets out there. We have what we call risk-free assets, government bonds, but even those do contain some risk. Now, as CFAs and portfolio managers, we have many ways of defining risk, but the two most common ways are the certainty of receiving a return on our investment. So if we make a loan to somebody with trust money, are they going to pay us back our loan and pay us our interest? If we buy shares, are they going to pay us dividends like they say they will? And are those shares going to go up in value over time? So that's one definition of risk. The other one is volatility. And that simply means how much the trust value goes up and down over time. Okay, so it's certainly, and these gentlemen will talk about their portfolios and how they went down in value in 2020 because of the COVID stuff. They went down in value, but a lot of those losses were just paper losses. Stocks and bonds could go down in value, and they can turn around and go back up again. They fluctuate, and if they fluctuate a lot, we think that's risky. So volatility is another measure of risk in the portfolio. Now, as I say, risk cannot be eliminated. There's no way to get rid of risk completely, but it can be reduced. Okay, there's nothing guaranteed in the financial markets. Diversification is the only proven way to reduce risk. And basically, it's just like your grandmother told you, don't put all your eggs in one basket. It's spreading your money evenly, not evenly, but around the world in different investments in smaller amounts. So if you buy an investment in something, in a stock, and the stock doesn't do well, it doesn't hurt you that bad. If you'd had all your money in oil in the last couple of years, you would have been absolutely smoked in the market. Okay, but we didn't. We had money in all sorts of different stocks, and these gentlemen are going to talk about that. So diversification is really, really important to every portfolio. So it also helps to have a good investment policy statement, okay? It will reduce your risk, reduce and control your risk over time. The Wikwemikong Trust has a good investment policy statement. Basically what it turns out to be, it's a job description for both Lincluden and Dixon Mitchell. It tells them what they can and cannot do. It takes the investment requirements in the trust and helps give them a work plan, something for them to follow, which they do. And that's part of the compliance part of it. They have to follow the investment policy statement, the guidelines we set down. I have to check that every quarter. Every quarter they write us a report saying, yes, we followed the statements. So that's good, but that's just one check and balance on make sure that these guys are following the rules as they should. Asset mix. Okay, the investment policy statement gives us an asset mix. And basically what that is, it just tells us how much we have in cash, bonds, Canadian, US, international stocks. And this is where the diversification comes from. Even if these guys wanted to and said, you know what, the US is the best market in the world, we should have all our money in the US. They're not allowed to do that, because the investment policy statement says you must have your mix like this. They have ranges on either side. So if they like the US, they can go from 15 up to 20, and then Canada, they can go up to 25 or 30 if they want. That's fine. But they can't put all the money into any one market, because again, that's not diversification and it's not a good thing. People say, well, why are we all Canadian? Because we live in Canada. Because the Canadian market is very small. It's only 3% of the international markets. So we really have to make sure we're properly diversified with US international stocks. So the asset mix is really important. I make sure every quarter that both firms are within the asset mix ranges, which they are. They never vary, which is good. Now, when the trust is invested properly, it generates income. Okay, and we do that because a trust holds high quality bonds that pay us interest. A bond is where we lend money to somebody, the government of Canada or a province or a corporation, and they pay us interest. And then when the bond matures, they pay us our principal back. That's one way we get income. Stocks is the other way. Stocks pay us dividends every 3 months. That should be, not 4 months, 4 times a year. And most of the stocks that we own do pay us dividends. And so these payments, the dividends and the interest, those are pretty much, we're going to get those no matter markets go up or down, because very, very few companies reduce their dividends, and the interest in the bonds is a contract. So we're going to get paid that. This income flows out to the nation every year. And last year it was about $843,000. Should be about $450,000 in 2020. Now that's just interest and dividends. A lot of that capital, the 843, was capital gains. So we bought a stock for 20 and sold it for 40. That's a capital gain. We get capital gains on that. We're going to generate some capital gains this year too, but we know we're going to get interest and dividends of about $450,000 in 2020. Now, our investment managers, diversification, besides having money in Canada and US international, that also goes down to our investment team as well. So we've got 2 different managers. So we've got a growth style manager that looks for good companies that are going to grow their business over time. And Don's going to talk more about that. But that's Dixon Mitchell, and that's Don Stewart. Value, they're bargain hunters, and that's Lynn Cluden, and that's Wayne. And he's going to talk about how they operate as well. But they're 2 different styles, and sometimes one will be doing better than the other depending on the market. So it's a further level of diversification by having 2 managers rather than having just one manager. And if their style is out of favor, you're going to suffer from that. We split the money in 2 and say, okay, now we've got 2 managers. So it's another level of diversification. Again, very common in larger accounts like Wiki. It's been proven, so it's what we go with. This is just an indication. This is at March 31st, 2020. It just, again, shows the diversification we've got. So the red is fixed income. You can see the cash in US, international. They have different amounts because they have different ideas about how the markets work. But they're following the investment policy statement, diversifying around the world, so we're not too exposed in any one market. So they're following the investment policy statement, the asset mix, and this is just an example of that. Long term, okay? I say this all the time, but the greatest advantage that the trust has is time. It's going to be around for a long, long time, as long as the nation, and basically that's forever. It gives the trustees and especially the investment managers a huge advantage because it lets them look at a long-term time frame, which is the best way to go. Retail investors are very skittish. Sometimes they own stocks for less than a year. That doesn't give much chance for the investment thesis to play out. Both of these managers are looking long-term, 3, 5, 7 years. If you buy a good company and own its stock, it will do well over time. The stock is going to produce dividends, and hopefully those dividends are going to go up over time. And certainly the stock itself will grow in value. So you've got to give these things time to make money for you. And that's a huge advantage that the trust has got because it's going to be around for a long, long time. As long as the trust is in good, solid companies with good products and good leadership, it's going to do well. Okay, I mean, the markets go up, they go down. Certainly in 2008, and even with COVID, the markets went way, way down. People panic, they start to sell. Our managers don't do that. They're professionals. They're actually buying when things go down in value, which is good. If you're buying a good, solid company like TELUS or the Royal Bank, these things are going to be around for a long time. They're going to pay us dividends, and they're going to give us a good return as we go forwards. But it takes patience, and that's one thing we've got. We are patient. The investment policy lets us be patient, and the investment managers have a long-term view on things, which is really, really important. That's it for me. So thanks very much. And I should have said this before, but I hope everybody is staying well up in the nation. I know we'd like to be there in person. We certainly like to get into the territory and see people and have a nice dinner with you guys, but it can't happen today, and I'm sorry about that, but hopefully we'll be able to do it next year. So now I'm going to turn the floor over to Wayne Wilson from Lynn Cluden.
All right. Well, thanks, everybody. Wayne Wilson from Lynn Cluden Investment Management. And I will start off by wishing on behalf of all of the partners at Lincluden that everybody at the nation is well and staying safe through this very difficult time. And I'll echo Jeff's comments that we'd much rather be up at your beautiful nation this time of year, enjoying a nice meal like we did last year around the same time. And we look forward in the not too distant future to being able to do that again. As a firm, we have every confidence that the brightest minds in the world are looking at this situation, doing the best to keep us safe, and that a cure or a vaccine will be in the offing in the not too distant future. So with that, I'll, let's see here, okay. Give you a brief introduction to Lincluden. Lincluden's been around since 1982. The actual genesis of the firm, we're an institutional investment manager, and the original and founding partners were actually an internal pension plan for a large steel company called Fiscal, and they decided to go out on their own, and Fiscal themselves had such confidence in the team that when they left the firm, they still took the entire pension plan to manage with them and start their business. And those folks are still a client today. So we've had clients since inception. We think that speaks to the fact that we pay close attention to our clients. We put our clients first. And over the long haul, we produce strong numbers because at the end of the day, that's what you've hired us to do. Today, we're part of the Morguard group of companies. Morguard is one of Canada's and North America's largest real estate entities. So you might see their name on a few buildings if you come into some of the larger cities. Together, we manage over $20 billion in assets. Morguard manages all the direct physical real estate, and anything that's in the what we call the liquid market, so stocks and bonds, is managed by Lincluden. Morguard owns a 60% stake in the company. Given their expertise as real estate, they don't get involved in the day-to-day. Our expertise is financial markets. The other 40% is owned by the partners, and there's broad ownership amongst the group. We have no other businesses but managing your money, and we're all compensated by how well we do for our clients. So we are a boutique firm managing just over $4.5 billion in assets in the market, and you can see the entire structure there. It's a very collegial, innovated group. As I said, we're all paid off of how we do for you. So you know, the group comes in every day, or now stays home every day, with one mission in mind, and that's serving our clients. So we'll move to the next page here with the asset mix. So this is repeat a little bit with just the Lincluden side of the page as to how you are invested at the end of December of last year. As Jeff said, we pay strong attention to diversification. We don't believe anybody has a perfect crystal ball. We have definite and strong opinions about what we think is the right thing to do at any point in time in the market. But like any good investor, we know we can be wrong, and we don't want our clients to pay unduly for that. And as a result, we're going to be diversified in your portfolio to make sure if we ever do make a bad decision, that you're protected and not having all your eggs in one basket. So coming into this year, it's only a few months ago, but it seems quite a long time ago. We had actually a little bit more cash and bonds coming into this crisis. We had no inkling that we were going to face the first pandemic for the world in over 100 years. But we did think that markets were a little bit expensive, that economies around the world were slightly slowing, and therefore we got a little bit defensive in your portfolio. That actually did help out when COVID hit. But through the period to the end of last year, that defensive posture actually cost us a little bit, but you'll still see that the returns were quite strong. At that point in time, we had $9.6 million of your money, and the balance that wasn't in bonds was in U.S. equities, international equities, and with a large part in Canada. We like that mix for your portfolio. The Canadian portfolio has a strong dividend bias to produce income to spend in the nation over time. The international equities are more focused, and US equities are more focused towards longer term growth to beat that inflation that Jeff was talking about for the nation, and increase the pot over time so that the dividends that are thrown off actually get larger. Call your attention to the little line chart on the bottom of the page, and that shows over the period that you have been with us since June 2017, every $100 at the end of December had turned into $114. Okay. In terms of what that looked like in absolute return over the period, last year was a strong year. Although if we hadn't been defensive, it could have been a little stronger. We were up 13.2% after paying fees over that time period, and we're up 5.7% compounded over the period that you'd had us at a manager. And the income from that was quite strong, estimated going forward for the year to be about $310,000. And that's dividends and interest on the bonds that were going to be in the portfolio. The way we view that is that's what the nation should be looking at as something they can count on pretty strongly to be able to spend. The capital gains, as Jeff explained, in any given year can go up and down. We focus on the long term. We have a 3 to 5 year investment horizon whenever we're putting a value on any security in the portfolio. And we try our best to avoid the short-term noise that, as Jeff alluded to, retail investors often get caught in. So happy to report through December, if your initial assets were just over 9 million, you've been able to withdraw and spend into the nation about 1.5 million, and you still actually had a little bit more money at almost 9.67 million by the end of that period. Well, as we all know, then COVID hit, and there was a time in March when things looked pretty bleak. World markets and Canadian markets fell over 35%, or more than a third of your assets on the equity side in 3 weeks. It's one of the sharpest problems that we've seen, and it's also a highly unusual problem. Most bear markets, as we call them, are caused by overexuberance in the economy, debt getting out of control, or just a few sectors of the economy getting overheated and people throwing too much money at it, and it causes a correction itself. This was a health crisis. It's unlike anything we've seen in our life. And as far as we know, there's never been a time when the entire economy basically was shut down by government order. So in that period, it's not surprising, as companies had to shut down, weren't making any money, that markets got chaotic, people panicked, in our view, and we used that time actually to deploy that capital. We went from underweight equities at that point in time. By the beginning of March, we were about 5% underweight equities in favor of more defensive bonds and cash. And at March 20th, we moved all of our balanced clients, that's clients who own both equities and bonds, back to a full weight in equities for the first time in a little while, because as we said, coming into the year, we thought things were a little bit overpriced. So Jeff described us as a bargain hunter. Frankly, in March, we were seeing bargains in high quality companies that we hadn't seen for a long time. And we went to a full weight in equities. We felt that was prudent. We didn't go overweight equities because this has never been an experience in our lifetime. It's a health crisis. And as this disease progresses, it can have further impacts on the economy. We expect a lot of volatility. But out 2 and 3 and 5 years, which is our investment horizon, we are highly confident that we'll put this behind us. The economy will restart fully. And as long as you have high quality, strong companies, they're going to be around for the long time, and you're going to get paid to own. Okay, so the other thing I'm happy to report, and this is results are to June 10th, which was the day before we sent this presentation off to Peace Hills to organize this meeting, that almost all of the income that we were predicting at the beginning of the year is going to be there this year. So that part is stable. And with the strong recovery and buying more equities when things were down and participating fully in that recovery, at the end of June 10th, you had still over $9 million in the portfolio, just slightly down from what you gave us, and you spent over $2 million or withdrawn over $2 million for the use of the nation. So in spite of all of the headlines, at the end of last Wednesday, you were down only 3.6%. So I imagine some people were wondering what this might look like. There's been a pretty sharp recovery from the bottom. We've participated in it. As I said, we think there's going to be a lot of volatility around that. There's going to be lots of ups and downs, as there could be a second wave, essentially. But what we're doing is looking through at what the companies are going to be earning 3 to 5 years out, and buying the ones that we think the market has overly punished and are undervalued, and you can make a lot of money in going forward. So I'll just spend a couple of minutes talking about how we do what we do. As Jeff pointed out, we're the value investor of this group. We look at what we believe are very high quality companies. We want to buy them when they're at a discount. So for whatever reason, they're out of favor in the market. For some period of time, the market is not recognizing the true value and quality that are in these companies. And based on our analysis, which is highly focused around the cash flow that we think these companies can produce going forward, we think that's a great measure to look at a company, because it's really a lot harder to monkey with cash. You can't fake it. It's either there or it's not. You can count it. There's no smart accounting person burying things in the back room when you look at the cash flows of a company. Or at least it's a lot harder to do. And we use that as a key indicator as to whether this company is going to be the cash flow that they're going to generate, as a key indicator as to whether this is a strong, solid company that's going to be in business now and strongly into the future. We love good dividends. We think they're highly appropriate for First Nation accounts, because, as Jeff said, it's not enough to make money. You want to be able to spend some. That's what these trusts are there, to help out the First Nations achieve their long-term goals. So we have a strong focus on those dividends going forward, and through periods like this, that it pays off, because there's probably at the end of this year not going to be a lot of capital gains to spread around in a period where the markets have taken a hit. And we do that by finding these companies at a discount. We would view that as a margin of safety in those companies. If you're already buying something that's discounted in bad times, these companies tend to go down less. So just taking a look at what we consider a bit of a fingerprint for Lincluden, and there's some technical information here, but I'll explain it in terms that I understand it, not just my portfolio managers. So first of all, the right-hand pie, it shows you where we're invested around the world, highly focused on Canada as per the investment policy and for generating income for the First Nation within those Canadian companies. And then a good chunk in the United States. They are more than half the rest of the world market by asset capitalization. So you have a strong group of companies within the US, and then a smattering of countries around the world in companies that you would be invested in those places, based on where we think we can find the best companies at the best prices that have the best opportunity to grow capital for the trust over the long haul. The left-hand side of the page shows you all the different types of businesses that we're in by various sectors. So insurance companies, banks, healthcare companies, consumer discretionary companies, so car companies, consumer staples, grocery stores, material companies, so that would be mining, energy companies, so oil and gas and renewables would be in the portfolio. So broadly diversified around the world, but in a concentrated group of companies that we think have a strong chance for success. So while we're invested in all of these markets. We're really investing in companies, not markets, and that we think that that's the best way to make money over the long term, add value over what you could get in just owning the market, and take some risk out of what's in those markets over the long haul. The fingerprint I'm talking about is on the bottom left-hand side of the page. And what that's really telling you is we're saying we're bargain hunters. On the right-hand side of the page, there's a whole bunch of measures as to what people are paying in their companies for earnings, for book value, for the amount of sales and cash flow that those companies generate. And you can see on the left-hand side of the page, we're paying less than the market for all of those things in our companies. And we think over time, the way we make money is that that gap's going to close. And people are going to recognize that the earnings that we're buying in those companies are solid, and those companies are going to have their price go up to the same price as the market. When it gets there, we're going to sell. And this is where we think our competency is at identifying these companies that are out of favor right now, that are unloved by the marketplace and are going to do very well over the long haul. The last measure there is an important one to us. We want to always be producing a higher income than the market, because one of the things we promise your trustees is that we'd be generating that strong income year after year for the benefit of the nation to use in your community. So just a sample of some of the companies that are owned in your portfolio as of June 10th. So one that Jeff alluded to, RBC, very strong. Canadian Bank and TD. You're going to see these companies basically every town you would go in Toronto. They're just about on the fourth corner of all of them, the four corners of the towns in all of them. Some others that you might know in the portfolio, Apple, software, and obviously Apple iPhones are very popular. Metro, a good solid grocery store, held up very well through this period, one of the companies that got to remain open. Walmart, Microsoft in your portfolio. We also own some companies that aren't huge dynasties around the world, where we find a good company that's still of a big size, but not perhaps known everywhere in the world as Superior Plus, consistent provider of propane to the marketplace, and well run, offers a great dividend. So been in your portfolio for a number of years as well. So that gives you a flavor of the type of companies you might find in your equity portfolio. I'll move right now to fixed income, give you a sense of what we own in your portfolio there. So again, we've got one of these pie charts up. In this case, it's all invested within the Canadian marketplace at this point in time. The green area there that you see on the Lincluden portfolio, those are corporate bonds. So they are we're essentially loaning large diversified companies money from the trust, and they're paying us an interest on that. We do the same thing with the provinces and the government of Canada. And on the right-hand side, that's the broad universe of bonds that are available essentially for purchase within the Canadian marketplace. You can see we're quite different. We are an active manager. We have quite a different idea than what the broad market offers out there. We have a lot less in Government of Canada bonds. The reason being is they pay the lowest interest rate. They're the safest over time, but they pay the lowest interest rate. And like the equity side, bond markets were having trouble. They were freezing up. People were panicking and dumping good companies. So we use that again in March. We use that opportunity to buy a little bit more of these companies in that period of time. We increased in particular our provincial weight. We thought that they were offering a much more attractive interest rate during that time period. And we also bought some high quality, solid company bonds at that point in time. And again, through the recovery, that's played very well in your portfolio, outperforming the market since the bottom to a large extent. So an example of some of the bonds that we might own in your portfolio, unlike the equity side, you're probably going to almost always see names in here that you would recognize that are large, diversified across Canada. We think that's appropriate on the bond side because we want to make sure that there's no potential for default in what we have in your portfolio. And default meaning that they actually won't pay you back what you lent them, or will have trouble paying your dividends, or sorry, your interest on the bonds over that period in time. So Royal Bank of Canada, Sun Life, CIBC, Rogers, TELUS, actually the company that runs the 407 in Canada issues debt. All solid companies that we have a strong belief are going to pay, and that we have, in our view, for the extra risks that we're taking by owning them instead of the government of Canada, a much enhanced yield or interest rate on top of what we can get for the government of Canada. And in our view, very well paid for the risk that you're taking for not owning the government of Canada, who essentially can't default because they tax us, and will always therefore have the ability to pay us back with our own money. Okay. That ends my formal comments, and I'll throw it to Jeff to be the crowd and ask me any questions that you would have over that period.
I think that was good, Wayne. I like, if you can go back up to your the one slide showing the amounts you have in various markets.
Sure.
Please. Right there.
This one?
No, back down. Back down. That one. I mean, that shows the diversification you guys have got, which is great. I mean, not only are you in different industries, you're in different countries, which really shows the whole thing about being diversified and how it protects.
Yeah, that's what we're most comfortable with.
No, and it's obviously, and down below the numbers you can see there, the price to book, everything is sort of higher quality and better than the market. So it just shows the kind of stuff you prefer to have in the portfolio for Wikwemikong. So thank you for that. I appreciate it. I can't think of any other questions. I thought your presentation was good. If we can switch now over to you, Don.
Okay. Guys hear me okay?
Yes.
It's over. As Wayne said, thanks everyone for tuning in and hearing our update. And to reiterate, hopefully we'll be out there for the next meeting, and things will have cleared up by then. In this presentation, I'm going to give a little bit more of a 30,000-foot review than Wayne did, and hopefully that'll provide a bit more insight into what both of our firms are seeing out there in terms of what's happened in the market and how our firm in particular has reacted. We'll talk a bit about, again, what's going on, how we've adjusted portfolios. And then, just as Wayne did, we'll talk about performance over various periods and a little bit of an outlook. Very tough to predict what's going on, but we'll try and put our best guess on what might lie ahead and how we're positioning the portfolio according to that. So just in terms of background, I think, all firms, money managers, of course, businesses in the real economy were taken by surprise by how quickly things changed this spring with the onset of the COVID crisis. And this graph actually tries to, or sort of illustrates that change. And so this is just measuring or showing GDP, so the world economic output over various periods and what was predicted. So the white line is economic output for the world up until the end of 2019. You can see that it was running at a pretty nice sort of 3 to 4%. And the dotted line is what all the economists in the world were predicting going forward. So pretty much the same sort of thing. And so we were pretty happy with with how our portfolio and how the economy would look, and expecting the same sort of 3 to 4% growth. The blue line is how estimates changed by economists when the crisis first hit. And you can see that initially it was okay. Well, we're going to have a bit of a dip, but then we'll get right back to where we were. And then the orange line was how things got revised in March to where we were going to see this sort of 3% drop in GDP. In fact, now I think we're looking more at a 4 to 5% drop in economic output around the world. And so certainly in my career history and possibly in modern investment history, we've never seen a collective estimate of where the world is going change that quickly. And so, markets reacted very quickly. And as Jeff said, the key was to stick to the plan and not, get caught up in the emotion and what was going on. And so, here we are now, dealing with what we see going ahead. And, it just gives you some idea of just within the space of a few weeks, how both the economy and what economists were expecting changed so quickly. So this has been a situation like we've never seen. We're not in the middle of a contraction or a recession or even a depression. Essentially, we just froze the economy. Aside from a few of the essential services that Wayne mentioned, pretty much everything was shut down. And so that was very different from the last difficult period we were in, which was 08-09. And in 08-09, we had a problem in the financial system, which led to an economic plunge. This time we had an economic halt, which led to financial stress. So certainly companies that were relying on income and cash flow to meet their obligations, the financial system as well. The effects of this economic slowdown really led to the financial side. One other big difference was that in 08-09 we could still go for coffee, and I say that kind of facetiously, but if you think about it, during that crisis, really the basic economic life sort of continued on, whereas here, even the simplest daytime events that we would be used to all got halted. And so, like I said, created a very different situation for all of us. And so if we look at similarities, of course, then versus now, a lot of worry that things will never be the same. I mean, back in 08-09, the word was, the financial system is coming apart, paper money isn't going to be worth anything, everyone should just buy gold and what have you. And of course, back then and now, we've had huge support from central bankers and fiscal support. So that's essentially things like the programs that our government has put in place to keep cash flow coming to workers and replace incomes and what have you. And so in both cases, that's sort of kept the boat floating, if you will. This just looks at in the US, just to show the difference between then and now, how money was issued by Congress to the economy. So I won't belabor the numbers on there, but the gray line and the gray bars show what happened in 08-09. It actually took a long time for that money to find its way to the economy. You can see that it was almost about 550 days before we got to a level approaching where we are now of capital being issued to support the economy. The gold line is where we were today, or up until recently. You can see that in just a very short number of days, Congress acted very quickly and liquefied and sent money into the economy to replace the economic activity that had dropped away. And so, Wayne talked about the recovery that we see in the market. I think part of that is owed to this, that instead of being asleep at the switch, government officials, both central banks and elected politicians have acted very quickly, which has mitigated the downside. So if we look at our approach versus what's happening now, let's get this out of the way. We're a bottom-up manager. So we spend our time looking at the businesses of individual companies. We spend time with management teams. We look at a company's ability to generate cash flow, a term that Wayne mentioned. We care about that as well. And we care a lot about the company's financial strength. So our view is that when we add up the collective value of those attributes, we'll buy the stock when we think it's worth when we think it's priced at somewhere less than the valuation of those attributes. For us, generally speaking, predicting where the economy is going or where commodities are going, interest rates and what have you, they're very hard to predict. And so we don't spend as much time on that traditionally. This situation, however, has changed everything to where now we need to think more about top down than bottom up. And so it doesn't matter how a company is doing, whether the management is strong or not, everyone's caught in this sort of top-down downdraft. And so just like in 08-09, this requires us to think a little bit more deeply about the macro economy. So what's happening in the big world around us rather than at the company level down for individual stocks. And so that sort of changed, at least temporarily, how we look at the portfolio. So for us, when we think about the situation, when the difficulties first started, the question wasn't, will the economy and corporate earnings be bad? We know that they will be. In fact, probably the second quarter and the third quarter are going to be some of the worst quarters for company earnings. But markets look forward, and so our question isn't the first one, but rather, will the economy and earnings be worse than what the market has already priced in? So we saw a big drop in the market, and then, as Wayne mentioned, a big recovery. And I think what people came to realize was that the market had overreacted, and if we look out forward, probably the outcome will not be quite as bad as what the market was originally pricing. So in this scenario, we're much more concerned about what's happening on the health front and how we can get the economy back going. Wayne mentioned vaccine. Obviously, that'll have a big impact on potentially how markets are traded and valued. And so those are the things that we really care about. But we also have to remember that stocks are forward-looking. And so, Jeff talked about time horizon. When we own stocks in the portfolio, it's because we're thinking about things to own for 3, 5, 7, 8 years. And the market really thinks that way as well. And so, you get these short-term reactions, but when cooler heads prevail, stocks and stock prices start thinking about, okay, well, what does this company look like in that longer period of time? And that's probably why we've seen a fairly strong bounce back. And if you look at historically, markets do tend to bottom about 5 or 6 months before the end of a recession. So if we think that the economy is going to start turning in September, October, November, well, that sort of lines up with the big plunge that we had in March. And so we don't, like I said, we don't want to get too caught up in the here and the now and really be thinking on plan about where the portfolio is going over those longer periods. So how did we respond? On the fixed income or the bond side of the portfolio, we made a few changes. If we look at, one of the big results was the falling interest rate. So at the start of the year, the 10-year Canada bond was paying about 1.55%. It fell all the way to about 61 basis points or 0.61%, which is around where it sits now. So that's a big change. And that happens because people, when they're feeling nervous, rush to safety, and that pushes interest rates down. For us in the portfolio, the bond holdings helped reduce the decline for Wikwemikong. And prior to the crisis, nothing to do with us predicting that there was going to be a health crisis. We had actually cut our corporate bond allocation, not because we saw something bad happening, but just because we didn't feel that we were getting paid enough to take on the slightly higher risk of owning corporate bonds. And so that put us also in good position because during the difficulties of March, as investors were looking to reduce risk, they tended to sell corporate bonds and buy government bonds. And so we were a bit ahead of that, mostly by good fortune. But that allowed us to avoid some of the difficulties in the bond market. As the downturn started, we reduced some of our corporate weightings a little bit further and used that money to rebalance back into other parts of the Wikwemikong portfolio. Now we're looking at a situation where we are underweight corporate bonds. If you go back to Wayne's pie chart where he showed government and corporate bonds, we're a bit underweight where we'd normally be. And so now that things are settling down and we have a bit clearer understanding of corporate balance sheets and how companies are going to fare, we're starting to move out the risk curve a little bit, which just means moving some of that capital that we had in the very safe area out to corporate bonds once again. So on the equity side, when we looked at the stocks in the portfolio, we did a full reevaluation of everything we own. And the first thing that we thought about was survival. How are these companies going to get through this? And do we have any situations where we think there's a risk that they won't be around? And so, number one, we looked at the liquidity, the solvency. So essentially, how much cash do they have available to get through this crisis? Are their outflows greater or matched up with their inflows under the new regime? And what's their outlook over the short and medium term? Really wanting to know that, of course, the share prices are doing what they're going to do, but underneath is the business sound, and will it be there on the other side of this crisis for us? We looked at what we thought were the maximum loss scenarios in each company, sort of looking at worst case outcomes, and trying to see if we could put a handle on what the downside for these companies would be, making sure that we were comfortable with owning them and where the share prices were. And we spent a lot of time talking to management teams. So you can look at numbers, but numbers were changing so quickly that we really wanted to talk to the management of the companies to get a better understanding of what they were seeing on the front lines, and how they were coping and positioning the companies to get through to the other side. So as a result, we sold a few names that we thought would face structural challenges under the new situation. Toward the end of 2019, we had already sold down much of our energy position. We were always underweight energy. It's not really a sector that suits our style particularly well. But with the onset of the crisis, knowing that people were going to be holed up, certainly not flying and probably not driving as much, we liquidated almost all of our remaining holdings. We have one position left in the energy producer area. And we took that money and we rotated it back into what we thought were stronger positions, or ones that would fare better under what would be the new economic world, at least for a little while. So in terms of asset mix, just shown a different way, the gray bars here are the policy weights for each area, and the gold bars are where we are. So you can see that the one area that we're underweight is Canadian equity. So you can see over to the right, we've overweighted foreign equity, which to us is US dollar equity, for a couple of reasons. One, we like the hedge of the US dollar, and two, generally speaking, Wayne talked about us being a growth manager. We can find more companies south of the border that suit our style than we can in Canada. So pretty much in line with the weights. The only area that we're off a little bit or deviated from policy a bit is in Canadian equity. So this just shows graphically how the portfolio has done since day one, kind of similar to what Wayne showed. So you can see that things were progressing along fairly nicely to the end of 2019, and we had the big plunge. And you can see that the bulk of that has been recuperated. So if you add up all those returns cumulatively since day one back in July of 17, the portfolio is up about 18.25%. And like I said, a big divot in the short term, but much of that has been recovered in recent weeks. So if we look at the numbers, to the end of December, things were going great. As Jeff mentioned, 2019 was a strong year, about 14.8% return. That produced an average return over 2 years of about 6% per year. And from the day that we had started the portfolio, it returned about 7.5% per year. So certainly above what the targets were, and well in excess of inflation. If we look at your report to the end of March 2020, things changed a lot. So year to date, at that period, the portfolio was down over 12%, which knocked our 1 year result down to down 7.5%. 2 years, the portfolio was flat. And you can see that from the day that we started, our since inception return went all the way from 7.5% per year to about 1.7% per year. But the next panel will show you what a difference a few weeks can make. So to the end of, last week, 8th of July, or 8th of June, 2020, that year-to-date return of negative 12.4% has climbed all the way back up to where we're only down just barely over 1% for the year. So again, what had been a big crisis has now developed or changed into just a minor blip in the portfolio. Again, the 1-year return goes from negative 7.5 all the way to positive 2.5. 2 years is back positive again. And our since inception return is back to a respectable nearly 6%. So again, as Jeff said, we wanted to stick with plan, make a few changes in the portfolio to make sure we were well positioned, but not make any permanent changes down when the portfolio is quite low in March, and sticking to that plan has brought it all the way back again. So we're quite happy with where it sits going forward. As was mentioned, I think we're going to see a fair amount of volatility as the market tries to figure out how close we are to things going back to normal. It's a bit of a one step forward, one step back right now as health outcomes change and different things happen in the economy. But I think for the most part, that very difficult period is probably behind us, and now we can focus on the plan and making sure that the portfolio is well structured for the months and quarters going forward. So how do we deal with the new paradigm or the new situation going forward? For us, we really want to think like a banker, which means that we want to think more about the balance sheet of a company. In other words, its assets and liabilities, and worry less about the income statement. So worry less about profits, because we know that profits are going to be very difficult to come by over the next few months. What we really want to know is that companies have the ability to weather this difficult situation, and that they're not going to be imperiled by having too much debt or not a strong situation on the balance side sheet of their financial statements. We want to focus our holdings. So, this presentation was made a few weeks ago for the broad group. And at that time we said the market recovery could be explosive. Well, it has been explosive, but probably going forward, not all companies will participate. We want to avoid sectors and holdings that will be fighting headwinds, and we'll talk about who those might be. We want to avoid those companies because I think there'll be some situations that are very difficult, and some companies that will find a tough time going forward in what is the new world economy. We also want to think more about our equity time horizon. So again, coming back to what Jeff said about longer term, we know that the next few quarters are going to be ugly, but we want to think about not the next 2 or 3 quarters, but what do the stocks that we own look like relative to the next 20 quarters of income or 5 years, and in that way we can step back a little bit and be a bit more long term in our thinking, and we want to own things that regardless of what's happening today, that will be looking good in that 3 to 5 year period, and that makes it a little bit easier to analyze and to make forecasts in the portfolio than getting too caught up in what's happening day to day. So companies that will face some existential threats in this new economy, travel. Obviously, we're all grounded. So we don't expect that airlines, cruise ships, hotels will have a very easy time going forward, and our habits might actually change for a long time. Shorter trips might be in vogue. Big long travel might be more difficult with a lot of the health protocols and things like that. So we want to stay away from situations like that are just going to have the deck stacked against them for a little while. Energy, as mentioned, we saw the price of oil come way down and it's bounced back. But a lot of these companies have a lot of debt, and especially in the U.S., companies that came up recently producing oil from shale formations took on huge amounts of debt, and a lot of them will have a difficult time surviving in the new regime, and so we want to avoid those. Retailers and restaurants are obviously going to have a tough time, and some real estate. So if you look at, I think certainly Wayne and I are at home, I think Jeff is too. If you own an office property downtown, you're probably wondering what the future looks like as companies realize that they can operate without all that expensive real estate. And so we want to be very careful in at least giving our portfolio the best chance going forward by avoiding some of these areas that are going to have headwinds or significant headwinds in the new economy. Again, debt is a big issue. There were a lot of companies with very low interest rates over the last few years that took on a lot of debt, thinking that income would always be there, to pay it off or to pay the interest on it. And now income has stopped. And so those big debt loads that they took on look a lot different now. And so we want to be very careful in the companies that we own. Again, products and services that don't fit into to our new way of living. Theaters are going to have a tough time. Are you going to want to go into a crowded place? Theme parks as well. Airbnb was, it's not a public company, but it was going to be a huge story this year with a big offering. As people do go back to traveling, is staying in a private residence where they're going to want to be. And so we want to think about all these big picture things as we structure the portfolio, certainly on the equity side. And there's a good chance that the strong companies will get stronger. So companies that come out of this with a lot of cash flow and a lot of liquidity and low debt can probably take advantage of the situation. Google right now, which we own in the portfolio, has $120 billion in cash. So no debt and $120 billion in cash. So lo and behold, they can go out and look for opportunities to buy their distressed competitors, to expand their business, to move into new areas, rather than trying to repair the difficult financial situation that they find themselves in. We own a company called Berkshire Hathaway, a small position in it, but that's the company of Warren Buffett, who many people have heard of. They have $130 billion in cash. So again, a great deal of flexibility in this environment, not having to worry about debt to repay, but on quite the opposite, looking at situations that they can take advantage of with that huge cash balance. So in summary, I'd say that, I think we can all agree that this economic standstill is like nothing that we've experienced before. In fact, several companies and industries won't survive. Things that, were happening already, telecommuting, grocery delivery, various other, less brick and mortar retail, more online shopping. Trends that were in place already have now been accelerated to a great degree. And so we're seeing companies that probably were in their sunset years anyway are now seeing an acceleration, to the end of their lives or to the difficult situation. And so that will definitely change the economy and how we want to think about portfolios going forward. We believe that those who will prosper in the equity area will have entered the crisis with a strong financial position. They'll provide goods and services that fit this new landscape. And of course, as always, they're run by strong, forward-thinking management teams that can adapt and take advantage and survive in this new environment. So in positioning the Wikwemikong portfolio, for us, we've considered all of these attributes, both to protect existing capital, which we've seen the portfolio is down just 1% year to date, but also to prosper from changes. There will be winners, and we want to make sure that the portfolio is positioned to take advantage of those companies and financial assets that are able to survive and prosper in this new environment. So that is our presentation. Thanks, Jeff. Jeff, any questions?
Thanks for that, Don. I think it was you that made the comment the other day when we were talking about the cash Google had and two companies they could buy and still have change left over.
Yeah, so if you look at Google, Boeing has run up, but I know a few weeks ago they could have bought Boeing and Airbus for cash and still had walking around money. So, that just goes to show you, there are situations and companies out there that are in fantastic shape. And if you look at when I think Wayne mentioned Microsoft in his presentation, Microsoft came out with earnings recently. They not only beat what analysts were expecting them to do after we knew that the crisis was on, they beat the estimates that were in place at the end of 2019. So companies like that, Google, Microsoft, whatever, are not missing a beat. They're earning as much as they were expected to before the crisis. And so, that sort of plays into that point of the stronger getting stronger and will come out with a lot of flexibility and opportunities on the other side of this.
Yeah, and I think you and Wayne both spoke eloquently about, debt. It's easy to say, well, we can take lots of debt on because we're making lots of money and interest rates are low, but people get sort of, and that's consumers as well. We take on way too much debt and suddenly there's a hiccup in the income or we can't make any money or individually, we lose our job or something happens, and all of a sudden it's a crisis. So it's really important to look at the debt. And I know you and Lynn Cluden both look at that very carefully, but it's been so reinforced. I mean, we were taught that in business school to make sure you watch that, but we all tend to get a bit complacent, I think, with interest rates so low. And then this comes along and just, it's the same thing we say over and over again. You've got to think long term. You stick to the fundamentals. You just, you do the things that are right and you're going to be okay. But if you don't, it can really cause some issues.
Yeah. Certainly a lot of companies that, as you said, thought it would be smooth sailing with the decisions that they'd made, suddenly have run into a brick wall. And, like I said, that'll create a big reshuffling of the deck. And through our analysis, we want to make sure that we're on the right side of that reshuffling.
Well, that's good. Well, look at Don and Wayne. I thank both of you for your presentations today. And I just wanted to tell the membership or anybody else who's watching this, if they do have questions or concerns about what's going on in the portfolio, they should contact the trustees and they will get back to us with any questions you have. I just want to reiterate what we said. We take a long-term view on this. The trust is strong. You've got two really, really good managers. We're going to give you good long-term returns. And I think it's going to be positive for, I seriously think that 3 or 4 years from now, the portfolio is going to be stronger than it was in 2019 because of the work done by Dixon Mitchell and Lynn Cluden. So that's what I'm thinking, because I just think it's going to be stronger with the companies they've picked up. And as Don said, stronger companies are going to do well. I think the income levels are going to go up in the dividends, and I think we're going to get some capital gains. So we just have to think long term and just get through this. So that's our comments for today. As I say, if there's any questions from the membership, they can certainly contact the trustees and ask those questions and get them to us, and we'd be more than happy to answer that. Any questions that you have, and we'll just keep doing what we do. So thanks very much, everybody, and stay well. We hope everybody stays safe. And to echo Don and Wayne, I hope that next year we can get up there and see people in person and have a lovely dinner and visit your beautiful territory. And I want everybody to be safe and look after yourself. Thanks, Sarah.
Thank you.
Bye, everybody.
Miigwech to everyone who has participated in this year's virtual Wikwemikong Trust Annual General Meeting. Thank you to Chief and Council, our investment team, and community members.